Welcome back, everyone, to another episode of Capital and Context. I've been away the last couple of weeks, so good to be back in the studio. This was an episode we had planned a couple of weeks ago, so hopefully we a slight variance in the sort of usual tone and context. But yeah, we thought we would try to have more of a game show sort of vibe to this episode and call it Acronym Anonymous. So although I did see a sneak peek down at my slide deck there, Sam, so no cheating. So anyway, firstly, how's your week been?
Yeah, it's been great. You know, we've had it's actually been a fairly relaxed week, although markets seem to have become more aware that Iran exists again. But otherwise just putting into process all of our prior planning, which is lovely when we get to do that.
Yeah. Okay. It's been my birthday this week. Thanks for asking.
We know that. I've already thrown lots of jibes in your direction.
I think I got wished happy birthday more times this week than
I noticed that.
And you got many others.
And you got quite a lot of presents, I understand.
Yeah. No, I didn't get any. I thought that was quite funny to make people
right.
think that they hadn't got me one, which clearly worked. So I'm glad that worked. Good. So on to the more serious matters, our game show for this week's episode. So we're going to alternate an acronym and see if the other person, obviously tied to the investment and investment world, financial planning world, or all investment?
Investment world.
Okay.
I've just thought, I hope our charterships aren't going to be under threat from this.
Yeah. Check out for any edits in this episode. So yeah, we're going to alternate, and the other should aim to try to give yourself, the viewer, an explanation of what that acronym is and what it means. So yeah, it doesn't have to be War and Peace. We keep it fairly light-hearted, but yeah, for those of you that often stumble across acronyms, maybe this will be the episode where a few of these demystified. So would you like to start, Sam, or
It
me?
is. I am. So this is the starter for 10 rounds. So just to get us in the flow, half a point each and 5 each.
Okay.
So your first is NAV.
Okay. Well, NAV is net asset value, which is something that applies more to the investment trust world, I would say, where the sort of deemed complete value of the company assets that the fund has invested in are derived, and that sometimes can derive a therefore different share price, because if you do the total value divided by the number of shares, that's the net asset value. But the share price the fund is actually trading at could be different. So there's sometimes also a divergence between the price the fund, the investment trust is trading at, and the net asset value. And that's something investors in that space look at actively.
Ping.
Right, first one for you, fairly easy one. ETF.
Exchange traded fund. So these are, you'll hear we talk about these quite often on podcasts. So these are, instead of 90% of what we invest in is a mutual funds, but they're not listed on any kind of exchange like London Stock Exchange, whereas an ETF is. So an ETF is in essence is a listed instrument that holds a lot of other instruments within it. You could kind of go into sub-variants there, kind of say like ETCs, which is exchange traded commodities, or ETNs, which is exchange traded notes, which is more on the fixed income side, whereas ETFs typically tend to be more equity orientated. Sometimes they can be geared.
Still only get 1 point, Sam. So.
And I'll just have, these are meant to be quick fire.
1 point ping.
Thank you. I wonder if this one might trip you up. FTSE.
Otherwise known as the FTSE. I would say the Financial Times Stock Exchange.
Yeah.
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 I don't know why it's tied to the Financial Times.
I assume it's just some old sponsorship agreement
Yeah.
with the LSE way back.
Yeah.
I assume, ting, give it
But
one.
yes, the main UK stock market, the FTSE 100, Financial Times Stock Exchange, which obviously has its 250 and other variants.
Yeah. I'm going to have to Google why it's the
No
FTSE
bonus
now.
points either.
No.
No. Okay. Next one for yourself. GDP.
Gross domestic product.
Yeah.
Basically the sum of all products and services generated within predominantly within the country, but could be a little bit larger if you're talking about Eurozone, etc. But yeah.
Economics textbook 101.
Let me go back to A levels. P/E.
P what, sorry? P
P/E.
is the acronym for the price to earnings ratio of a share. So yeah, it's I guess an investment metric to derive some form of value of one company versus another company, because their price should be a factor of the earnings, and I guess trends in price over earnings would be significant for the direction a company's taking.
Yeah, it's a comparison of what multiple of a company's earnings you are paying for. So in essence, if their earnings were to remain stable like over the longer period, how many years of that company earning that do you basically have to wait for you to earn what you've paid for it back?
Thanks. Do I get to validate your answers as well?
No.
Okay. AUM.
Assets under management, which you always want to be larger than you have. So very simply, the value of all of the assets that a fund manager holds under their mandate. You can have it at a group level or at a fund level. Something that personally I look at is quite important from a due diligence perspective, because you don't necessarily want to be an overly large size fish within the fund, because it could create liquidity issues. But just to add a little bit more flavour on the bone for that one.
Yeah. And what's the difference of AUM and AUA?
Well, one is your world and one is my world. So AUM is more of an investment kind of mandate, whereas AUA is assets under advice. So that's kind of more, obviously, a lot of people on this podcast would be clients of Mark, under the IFA world, the financial advice world. So that's kind of where you sit.
Yep. No bonus points still.
No.
Okay, next one for me.
OCF.
I can describe what it is, but I'm just making sure I've got the words.
I was going to say, it's typically something advisors are very sensitive over.
OCF.
OCF.
Is it ongoing cost of the fund?
Figure.
Ongoing cost figure. Okay.
Yeah, I got to that one.
That's why I was like, I can literally describe this inside out, but that was a tough one.
So ongoing cost figure, which is the total annual cost of running the fund. So that includes transaction costs, etc.
What did I say? Ongoing charges figure.
No, you said ongoing charges fund.
Okay.
As a percentage of the fund's total assets. Includes the AMC and the operational costs. Excludes transaction costs and performance fees. Good job, I didn't get asked that question.
Yeah, that was a toughie. Next for yourself, Sam, EPS.
Earnings per share. Literally, the total earnings made by the company divided by the number of shares in, I would argue, in issue. Doesn't matter about the free float. It's about all of them. Or if I got that
core measure of what?
Investment returns.
Corporate profitability.
I mean, very crudely.
Just trying to get half a point back.
I could easily argue it's easily adjusted and not something to be trusted too much with
Well,
put my lending hat on.
You can keep your point.
I hate it when you go down the lines of I owe you one because you'll bring it up after the podcast. IPO, not IPA.
Yeah. Initial public offering. So that's the process of a company coming to market for the first time and converting from a private company to a public company that is tradable.
Thinking back to many essays I wrote on this in my bachelor's a long time ago now. I could write War and Peace on that. So.
So last one for you. So technically to win this round. YTD.
Technically. Oh, is that year to date? Not something that we throw on our WhatsApp conversations very often. I don't think that needs further discussion year to date.
No.
I'd like to point out I did not choose who got what questions on this. So after one round, that's Mark on 4.5. Sorry, on 2 points because they're half point each, and myself on 2.5. Yeah. Ooh, interesting. So the next round is called the close calls.
Okay.
So 1 point per pair, awarded for distinguishing both correctly. So we got to distinguish between familiar sounding or frequently confused acronyms. 3 pairs each. You ask 3.
You can go first.
CPI versus RPI.
So I've got to get both.
Yeah, and explain the difference.
So CPI, Consumer Price Index, versus the Retail Price Index.
I saw those eyes wandering then.
No, it's not. I can't read your notes.
Just said the sentence
and
and
read.
read.
Differentiation between the two. It's to do with the basket of the basket.
It is
the differentiating basket of goods in the two measures. I couldn't tell you which of the two is more broad off the top of my head. Let me just think it through.
One is basically
I'm gonna say one is more the basket of consumer driven goods, being the CPI, and RPI would include things like oil and other things like that. But
so
enough for my point.
Fuel is include. You get 1 point out of it.
Yeah.
So CPI does include fuel.
Okay.
RPI includes what's called household costs. Actually, mortgage interest payments get included in RPI, but it's pretty much defunct. And the only thing it's used for these days is, funnily enough, when the thing that your mobile phone wants to be attached to for inflation linkage, because it's typically about 0.5% more than CPI.
So they're both still defining a basket of goods, just a slightly different basket of goods.
Absolutely.
Oh, that's 2 points.
Can you tell how my and Mark's discussions in the office often go right now?
Okay. QE versus QT.
That's quantitative easing versus quantitative tightening. Something that a lot of people get overly emotional about, particularly on social media. So quantitative easing is in essence the process where a central bank will purchase securities. Note how I say securities, not just government debt, because they've also been known to buy corporate debt, but also in case of Japan, I think Japan at one point was literally buying equities, the Bank of Japan, and hold them on their own balance sheet. But it's kind of called like creating free money. It's an exercise of basically increasing the liquidity in the financial market system. Whereas the reverse is quantitative tightening, so that started to sell off assets that they hold on the balance sheet.
Okay.
Was that a yes?
Yep.
The difference between us. Bull versus bear market. Can you remember the line where it is officially called one or the other?
In terms of stock market movement, or in terms of...
Yeah, I had to look down myself. Confession.
Okay. Well, yes, there's two different terms for the description of the current trend of a particular market. It doesn't necessarily have to be a stock market, and can also be a description of someone's belief in how they feel about a market as well. But yeah, a bull market would be one where generally prices are rising. And I believe the market, if what you were trying to get out was 20%, a 20% mark, the markets are meant to either go up or down 20% for it to be deemed a new bull or bear market. And a bear market is to describe a market that, is going down in price, or again, feeling bullish. And bearish is kind of like a feeling of whether we think something's going to go up or generally down in price.
Ping. We need to buy like a set of like really cheesy sound effects to add.
Yeah. Oh. Jay can add that in edit. Yeah. Little ping.
Oh, yours is next.
As long as we don't have like a for the one I got wrong, the one slip.
I'm pausing because there's something else downstairs that we could have brought up.
Okay, the next one for yourself. These are easy for you. Alpha versus beta.
Oh, I had an argument with someone on this subject recently. So anyone who's doing their bachelor's will instantly think of a capital asset pricing model formula. So beta is in essence a multiple of an underlying index or sector that like a security be priced within. That multiple kind of it says that, say a market goes up 1% and you have a beta of 1.4, you'd expect that security to increase by price by 1.4%. The alpha figure is basically the difference between that and the actual real world, what happened. So in our world, say if we had a portfolio which had a beta of say 2 versus its benchmark, if that was the case, I'd be seriously messing up in my job. But you'd expect, say, our portfolio to be double the performance. But if it's actually underneath that, then you'd end up with a negative alpha. So that's the alpha figure is kind of like the extra bit that you could argue is the performance that extra security that a manager either of a company or as a fund manager you add onto that security or set of securities. This is a nice easy one. FTSE 100 versus FTSE All Share.
Okay. FTSE 100 is the marketplace for the top 100 companies in the UK. By market cap, by market capitalization. Sorry, that's another acronym there. Cap. So yeah, top 100 companies, and yeah, that changes over time. Which are those? So there's a sort of coming in, coming out process to the top 100 companies. And then the FTSE All Share is an index that is representative of all of the companies across all of the FTSE indices. So it'd be all the companies in the 100, 250 added onto that as well.
Yeah, everything that's on the LSE main market. There are other markets on the LSE, but everything that's on the main market.
I was panicking for a second and thinking, is it X, the FTSE 100 stuff? But it is the link, yeah?
This is interesting. You're doing a series of body movements I've never seen you do before. Like the reaching around, scratching your head fingers. Like, I've never seen you do that one in 10 years. So, yeah, I'll give you that one.
Okay. Another easy one for you.
You got the FTSE 100.
Fair enough. ETF versus mutual fund.
I mean, I've already done this one. So exchange traded fund versus mutual fund. One thing I would say actually is more relevant on that one is that within the UK, there's various different regulatory structures, but 90% of what we deal with in terms of mutual funds is an OIC, which is an open-ended investment company. Yeah. There is also SICAVs, etc., but we don't typically deal with those a huge amount on platform.
What does SICAV stand for?
I bet it's something in French.
It's important. It's part of the point.
It doesn't actually list it on there.
It's part of the point for this question.
Security in... I couldn't tell you.
It's not there. It's not there. You're lucky.
Okay. Yeah, a mutual fund, in essence, you could argue the share price doesn't really change when you buy into it because you continue to buy extra securities of the underlying, whereas it just issues more and more shares, but at the price that you pay into them, if that makes sense. I feel like this needs a full diagram. It isn't very good for a podcast, to be honest, to explain it properly. Whereas an ETF, as I mentioned, is exchange listed.
Okay.
So after
Draw.
that, I was when Mark says draw, what he actually means is I'm still leading after 2 rounds. Do you want to intro this round?
On to a very exciting final little round here, the 1 minute round.
Shall I pop these on top just so that we because otherwise we're going to see the
okay.
We're going to see the answers beforehand.
Let's see how many you can get from the rest of this pack.
Have you already set the timer?
No.
Oh, I was going to say, is us introing it?
I've got it ready to.
Sorry, I've got it ready here. Just remember to pull it down half away because otherwise it will give
What's
the.
that? Oh no, I'm still going to do them out here.
Okay.
Yeah. Okay. Right. Are you ready?
I was born ready.
Okay. This is also helped by the speed that we read each other's respective answers at. That's in 1 hour. Hold on.
1 hour. I'm not sure our listeners.
DCF.
Discounted cash flow.
With explanation.
Basically, so each year's cash flows are divided by the time value of money, typically used as the risk-free rate government bond for that time period.
EBITDA.
Earnings before interest, taxation, depreciation, amortization. So basically, that's your earnings before any accounting fancy treatments.
PMI.
Surely not private medical insurance.
No.
Oh, pass.
Brick.
Pass.
You're passing on brick.
Brick?
Sorry, FX.
Foreign exchange. So basically, the difference in value between one currency and another. This is very slow turning of the page.
NASDAQ.
Oh, I couldn't tell you what that stands for. I couldn't tell you what it is, but I couldn't tell you what.
Okay, time up.
The whole slow you changing that page.
Time up. There we go.
I actually don't know how many answered.
Okay. What did you see? You got discounted cash flow.
Yeah.
EBITDA you got.
Yeah.
PMI you got wrong.
What was it?
Purchasing Managers Index.
Of course it is.
Then this one you had a nightmare. Brick. Brick.
What is in Brazil, Russia?
Yeah.
But it's BRICS, sir. It includes it in there. That's not fair because South Africa's on there as well.
Expanded to BRICS.
That's cruel.
Technicality. So that was a no.
So
and then you got FX.
Yeah.
And then you didn't get NASDAQ. National Association of Securities Dealers Automated Quotations.
Oh, come on. Let's be honest, how many people go?
No.
But in essence, that's the one for the techie index, in essence. Okay, so that's 3.
Okay.
So, Mark Inslee, you need 4 to not be paraded around the office that you lost.
Yeah.
That I will not hold for
Are
you.
you happy for me to start it? In fact, are you ready?
I'm just checking. I just double checking what you got.
So I've got to get 4. I've got to get 3. 3 to draw, 4 to win.
You've got to just get 4 to win.
Okay.
You never said anything about not recategorizing
Ready?
this. Okay. S&P.
I haven't started it yet. Okay, ready?
Go for it. S&P.
Standard and Poor, the name for the US, another name for the US index
I'll give you that.
company,
ESG.
ratings company. Environmentally, social, and governance.
Yep. ROE.
Return on investment measure.
IRR.
E or I?
E.
I can't. Earnings. Return on earnings. Carry on.
IRR.
Internal rate of return, a derived measure of risk or return.
DPS.
Department of Pensions and Securities.
Dividend per share.
Oh.
DAX.
Pass.
Cape.
Pardon?
Cape.
Cape is.
Ooh.
Well, it's an
The answer we were
it's
looking
an
for-
earnings measure, but I wouldn't know what the CAPE is.
The answer we were looking for there was the cyclically adjusted price earnings ratio.
Okay.
I hate. And the one that you missed was DAX, which stands for Deutsche Aktienindex.
Yeah, I knew it was going to be some.
Damn it. That was
You
the
had
one.
CAC next on yours, so it was always good.
That was 1, 2. I think you won.
I think I did, yeah. I also got you into giving a really long answer to the discounted cash flow question that burnt about 15 seconds. So, okay,
It was 4.
good.
You won by half a
one,
point.
one all and a draw.
That's good. As we all know, you
Well done.
you never annoy the person who's in
Thank
control
you.
of your mortgage
Thank you.
payments.
Good. Okay, so yeah, that's the end of that episode. We'll be back to more serious themes and explanations next week. But yeah, thanks. That was good fun.
That was. I'm going to be in a bad mood the rest of the day now. Thank you,
Okay.
everyone.
Thank you, guys. Cheers. Bye.
Bye.